Time to check in or check out. That's the conversation point on talking point all of this week. We spoke to Andrew Holland yesterday, and we're speaking to a very special guest today, Ganeshram Jayaraman. He needs no introduction, really. His notes are now his and his team's notes are now circulated very, very widely and much sought after for the kind of thesis and the kind of work that they do for the near term, medium term, and the long cycle analysis that they bring out in their notes. So I thought it's best to get him in to talk about that piece as well as some of the other high frequency indicators that we want to speak about. Ganesh, great having you. Thanks for joining in.
Pleasure's mine, Neeraj. Always good speaking to you.
Yeah, no, the pleasure is really ours, Ganesh. So let me start with the motherhood question, and then we'll get to the others. In a veiled way, market kya lagta hai? But more importantly, now that I know we've had a correction the last 2 or 3 sessions, but let's say in terms of from the lows of 15,300, that we've had this rally, but the problems that persisted probably are still there. Would you recommend that people should be cautious about putting fresh money in the table, or rather even take some chips off the table? Or are you reasonably bullish?
I've been very positive through this correction. Okay, I think if somebody had told us on say Jan 1st that there'll be a war in the Western world, and due to which oil will be in excess of $115, $120 per barrel, India will see $25 billion of FI outflows, and we would have seen rate hikes by central banks to the magnitude that we have seen. And then if somebody had told, in spite of all of this, markets will be giving higher returns this year, we would have possibly laughed, right? But that's the reality. And India has actually outperformed. The Indian currency has also outperformed, and that's where our view has always been, that we are coming off the COVID challenges. We have actually been in a lot stronger balance sheet. What I mean balance sheet is at the country level, forex reserves is the strength. At the households level, the bank balances. At the corporate level, the balance sheet. So when I look at all these, our view has been that we have actually come after the COVID challenges, we have emerged stronger, and that will help us recover faster, recover qualitatively better. And that's consistently been our view, in spite of all the challenges that we have had over the last 6 months. We have held our view that this is not the time to throw in the towel. We have been positive on how the quality and the character of recovery that we will see. We have been positive on it. So both the medium term and the structural long term view has been positive from our end. And we have not recommended clients to go under the umbrella and buy defensives or buy global cyclicals. It's opposite. We have said domestic cyclicals has been our most preferred segment of portfolio, or the kind of topics that we have had has been our recovery centric, and that's we have held it through this challenging last 6-7 months horizon.
Ganeshram, a view that came yesterday across, and would love to understand, there'll always be different views, but I'm just trying to understand where you stand on this argument, is that if indeed, because of higher gas prices in the Western world, winter coming and maybe higher crude prices, who knows, supply chains still not completely out of the woods, that inflation might stay stronger for longer in the West. One person was making this point yesterday that there aren't enough waiters in the US. That shows that how people are simply staying on the back, and this wage inflation issue will not go away, which might prompt the Fed to stay on course for rate hikes for longer than what the market anticipates. And therefore, could that mean a tactical correction in the market? I know your medium term and long term view is positive. I'm asking you to wear a bit of a trader's hat and tell me, do you reckon that there could be tactical moves downwards because we've already gone up quite a bit and some of the pressures persist?
I won't rule it out at all, because I've been on some global road shows as well, meeting clients, and when you are on the road meeting them, you watch what's around. There is everywhere there are vacancy boards hung across restaurants and shops and everywhere. The pulse you're getting it's not a usual pattern of recession we have seen in the past. Okay, this kind of slowdown or technical recession is very different in character, and I think markets are also reflecting that. Okay, their reaction to a normal slowdown or recession will be very different to what we are seeing as reaction today. It is in that sense a very different approach. I think will markets cool off in the short term? I'm not an expert in exactly highlighting that to you. I'm generally quite bad at it. But when I actually take a slightly distanced view, okay, I believe that even if central banks further take rate hikes, even if inflation persists longer, I see that this is not going to impact the way we see recovery in India play out. In the sense,
Okay.
we think actually if Western world slows down, it's actually good for India. This will bring commodity prices down. And that's actually a bigger positive for India than the negatives which could come along with it. I'll tell you this with certain the way we are looking at it. In fact, we think companies have managed the inflation environment extremely well over the last 6 to 9 quarters. Okay, we've seen pricing power demonstrated admirably. What I mean, I'll explain. Margins have come down for sure. Earnings have seen downgrades. But what we think the street has ignored is companies have protected their per unit gross profit. Okay, steel is up 50% and aluminum is up maybe even higher, but companies have been able to pass on their price hikes to the end customer, and even while protecting per unit gross profit. Okay, and what that means is while volumes have been impacted and operating leverage has had its negative effect, and you've seen earnings get impacted, top line get impacted over the last 2-3 quarters. What, and even if you compare it with say pre-COVID levels, profitability at a per unit level has not got impacted across sectors, be it autos, be it consumer durables, be it or various segments in consumption as well. So that's where we think companies have demonstrated their pricing power in spite of inflation being quite high. Now, which means vis-a-vis the street's concerns on margins and earnings, we think demand is the key point, and our confidence comes from demand recovery likely to play out over the next 4 to 5 quarters. And when demand recovers, the whole per unit gross profit, which has got protected, will lead to operating leverage. As when demand plays out, those fixed costs get defrayed over higher top line, and you'll see operating leverage play out. And if commodity prices cool off, as we have seen over the last say month or so, right, you will also see at companies' pricing power in India is never demonstrated when raw material prices are going up. It is when raw material prices go down that companies do not take price cuts of the same magnitude, and that's when margins expand. Okay, we have seen this consistently. So the point to be noted is if demand recovers and if commodity prices cool off, invariably the two go together. Okay, that's when earnings upgrades happen. That's when margins upgrades and ROE upgrades happen. Cash flows will improve. We are expecting that to play out on domestic segments. Exports, question marks are still there. Export oriented sectors where we will still be a little more cautious on how we'll estimate earnings in those sectors. But the domestic cyclicals, be it in consumption, in including sectors like autos or discretionary consumption, capex sectors, the industrials, these are sectors where we are more positive on. And we see, again, it might not happen in the September quarter itself, but as we play out over the next maybe 4 to 5 quarters over through calendar 23, we think this whole expectation of ours should play out as earnings upgrades for fiscal 24, and that's where we remain positive on earnings trajectory. We think there are about 5 different drivers of demand recovery. Point number one is on the fiscal side, and we are seeing very good tax buoyancy on personal tax collections, on GST collections, on corporate tax collections, and we think they can offset the pressure on fiscal imposed due to higher fertilizer subsidy or higher food subsidy, or even the lower duties which have been imposed. So when I weigh all of this, our assessment is the government's capital expenditure budgeted is unlikely to be impacted, and government's expenditure on capex front is about, or the central government level is about 7.5 lakh crores, and revenue expenditure of another maybe 34 lakh crores. So you're here talking of at least 40 lakh crores of government expenditure unlikely to be impacted due to the pressures which have been imposed. We think that's a very critical demand driver which will be unimpacted as the year goes and into next year. That's point one. The second is we think April itself saw the peak inflation. So when we look at even in our $120 per barrel for India oil scenario, we think inflation has peaked out, consumer price inflation. So we don't think interest rates and inflation have further upside from where we are today. I do see rate hikes by RBI, 50 more MIPS of rate hikes between now, but bond markets have priced it in already at about 7.4, 7.5% bond yields. We think this is inflation and interest rates are possibly largely known and largely priced in. So that it's not going to be another demand impacting driver going forward. The third is on the BOP and will India lose more forex reserves? And keep it in mind, it's not a rupee call, it's a demand call, okay? Because we have seen that whenever forex reserves fall by say 10%, okay, demand gets impacted, okay, because money goes out of people's pocket and that leads to lesser demand, and invariably we have seen earnings downgrades and markets correction, demand impacted over you go back last 25, 30 years, each scenario that plays out. This time, it's not happening. The reason is, every time that happened in the past, the liquidity in the banking system will turn negative, okay? And that used to spike rates and rupee depreciating sharply, impacting demand and earnings. And money flow used to be very strong. Now, has it happened this year as well? Money outflow, as it's true, forex reserves have fallen about $60 billion or so, and that's about 4.5 lakh crores. But the strength of our balance sheet was so strong that excess liquidity was 8 lakh crores before this. It's still at about 2.5, 3 lakh crores. So in spite of money outflow of this magnitude, we have not seen, or we are not likely to see demand get impacted this time around. That's the third point. Fourth is on the whole consumption side. Let's break it up into say maybe two parts. One is on the rural side. Okay, we think rural recovery can play out in the second half of this year and calendar 23, and the reasons are government's MSP increases. Keep in mind that while fertilizer prices have gone up, government has absorbed it as fertilizer subsidy, so the farmer is not bearing that cost, whereas food prices have gone up, so that's actually margins for the farmer. And also you're seeing government's rural spend, center and state, unlikely to be impacted. So we actually are likely to see a rural demand recover in the second half of this year and calendar 23. We also think urban consumption will remain strong. In fact, the reason is jobs, wage hikes. We have seen personal tax collections pretty healthy. We are seeing bank balances of savings bank balances, which reflects households' balance sheet in some form. That's pretty strong. Credit growth on the retail credit side unlikely to be impacted, even though deposit growth has moderated to well below credit growth. Banks are sitting on huge excess SLR, and there is a lot of CD ratio upside for banks. So when we weigh that as well, we don't think there will be a demand impact. So when we weigh all of these, and also the last point is capex cycle, where when we look at PSU company capex, private company capex, including PLIs led capex, especially on electronics manufacturing related, the property related capex cycle, both commercial and residential. So when we weigh all of this, we see a capex cycle also likely to recover. So when you say these are the 5 key points on demand drivers: government's infra spend, the inflation, interest rates unlikely to be a party pooper, uh, the forex reserves and unlikely to impact demand, the consumption, rural and urban, as well as the private capex recovery. When we weigh all of this, we think demand should recover. And go back to the first point I told you, which is companies are protected per unit gross profit. Now, if demand recovers, operating leverage has to play out. So operating leverage is ultimately the crux of how we are trying to pick stocks. Where can companies show asset turns improvement, margin improvement, and our fixed costs getting defrayed over a larger top line? And as a result, if the balance sheet is in good shape and companies are likely to see their top lines recover, you should see earnings upgrades as we go into next year, and that's what we are preparing ourselves for.
So where do you see these upgrades coming?
Primarily in autos, discretionary consumption, both rural and urban. In fact, it could happen in staples as well. Okay, we have always seen that. We see it in cement, we see it in industrials, the whole engineering, capital goods companies, or even property related companies. You will see it in the building materials and the derived proxies of real estate. You should possibly see it in the industrial consumables companies like bearings and abrasives and segments like that, and also construction. So those are where we are preparing. Apart from this, banks. Okay, I think the sector where you should see more earnings upgrades is banks. Combination of credit growth pickup, margins, because almost 40% of banks loan books are repo rate linked, and the funding cost, deposit cost doesn't go as much as the repricing of loans. So we should expect a margins trajectory, and also the excess liquidity, which I told you in banks balance sheet, the excess SLR, those getting converted into credit, better CD ratios mean better margins. So growth, margins, operating leverage, lesser credit costs. So return on assets and return on equity should improve for banks. So all of this is pretty much our model portfolio, kind of our top picks, preferred baskets, which is in terms of the sectors that we like are the domestic oriented sectors.
Interesting. A couple of questions on that, and then I also have a question on IT services, because that's the flavor of the day. But first, I think the first time, right, in over 3 decades that India has become a net exporter of engineering goods. So that's of course music to the ears. You think that entire ecosystem benefits out of this, Ganeshram?
See, keep in mind that some of the engineering exports was also tailwinds of commodity prices. Okay, so don't look at it in absolute, but the fact is we have gained market share from China. Okay, US imports from China declined about 313 basis points, to be more precise, whereas India's market share has gone up about 44-45 basis points. So we have gained market share. As Vietnam gained more market share than us, of course, answer is yes. But countries like Malaysia, Thailand, Korea, India, all of us have gained market share from China, and maybe some of these are Chinese companies, okay, which are diversifying their presence. But the fact is, it's going up exports have picked up from India. But exports are really not where I will be very positive about, because
you told me
the Western world, especially Europe, I think US is a lot more resilient, but Europe centric exports, we are wary of how it could play out. Germany and UK, some of these countries don't look strong enough, resilient enough and our exports could get impacted especially dependent on those sectors. But to answer your question, the China plus one and the whole market share gains for Indian exports is indeed happening. No two ways about it at all.
Got it. What about the reverse, Ganeshram? With the higher gas prices that are there in Europe, unfortunately, but a bunch of manufacturing activities might be finding it difficult to carry out manufacturing in the first place, or carry out manufacturing at the kind of margins that they would want. And therefore, we've heard stray stories of companies shutting down those productions, but trying to get contracts done from Eastern countries in order to meet the client obligations. Is that, have you seen some impact of this on Indian manufacturing exports?
We've not seen too many managements tell us about it, actually.
Okay.
In all the conference calls post the June quarter results, which we have attended, I would have not heard this commentary from anybody. Our channel checks don't tell us that this is indeed happening.
Okay.
Can it happen over the next 3-6 months as Europe goes into winter and the gas prices further spike up? It may happen. We have to maybe keep our eyes out to watch for it. But are we seeing that on the ground yet? No.
No. Okay. What about the other two spaces? One is power. I just wanted your view here, because I mean, what this whole LPS rules and barring discounts from power exchanges was kind of a strong messaging that I thought the central government laid out. Does this have longer term implications for a sector which has shown promise multiple times, but almost invariably failed to deliver?
We have been skeptics on power forever.
You are,
Neeraj.
not surprising.
Even when power was the flavor 15 years back, we stayed away from getting positive on that sector. The kind of reforms power sector needs are extremely challenging to implement. It is at the the distribution end of the power segment, and those are extremely challenging. Almost a fourth of the power sold is subsidized as free power to the farmers. So, and the households and industrials companies bear that, and that's why we are seeing our theft and everything. So, can we see the dues of discoms get addressed? It will be a real hyper optimist to expect that to happen. Do we expect it? Maybe fleetingly, some electricity boards on their shorter term dues, they might settle it, but there's still 1 lakh crore plus of dues, and I'll be maybe I also want to watch out. Are they borrowing from companies or from somebody and repaying them, or is it genuine improvement? Some tariff hikes we have seen, but still, for us to get longer term positive on power needs a lot more structural action, and I think it pays to be more cautious on that sector than anything else.
Most certainly. Before we wrap up, because we have to let you go, does it pay to be more cautious on IT services as well? You are not constructive exports per se. IT services has been written off a number of times, but today or yesterday, right, this news of one company or a couple of companies holding back the variable pay as well, in order to, I presume, an effort to protect shrinking margins. What's your sense around what's happening, and is this a passing cloud, or does it have more permanence in the near term?
We were wrong last year when we were heavily underweight on IT. And but this year we've been right. So it hurt us last year, but we've been helped. We continue to be quite cautious on IT. Okay, I think we still see. I've generally seen a three-phased upswing or downswing, either ways, right? It's three-phased. First phase, stocks correct, and it appears that stocks are cheaper. Second phase, earnings get cut. And then you realize that actually stocks were not cheaper. And then there's a third phase where stocks get corrected for multiples. We think we are in the second phase, where now we will see margin pressure current year. I think almost all our IT services companies, maybe except one or two, have seen margins get impacted and earnings getting cut. Okay. But do we see that translating into a demand impact next year? We will put reasonably high probability on that to happen. So we remain cautious on IT sector's outlook, both on top line growth, on margins, and multiples. The only savior is currency. Okay, on that we actually believe that the rupee will not depreciate to offset the margin pressure. So what IT companies are doing is trying to balance this I'm not exactly sure of the company specific.
Sure.
We have read whatever we have seen, but we think it's because of uncertainties, likely clouds in the horizon, especially in Europe, that companies are trying to protect their cash balance.
But just wondering, Ganesham, one final question, a counter argument to this typically has been, and from a bunch of managements as well, that maybe, just maybe, this time around, the typical recession playbook for IT services may not be playing out. I mean, I think Jamie Dimon was on record saying that as well, right? That some of the spends which were traditionally discretionary when it came to IT services are not going to be so, because companies are getting digitalized, and therefore there is probably no choice. And actually, with Indian IT service vendors, the costs might come down for Western corporates in a recessionary scenario. Could the playbook be different this time?
If you go back to 2001 to 3, slowdown, this was expected then too. Okay, it took 18 months for the offshoring to pick up. It takes time. It doesn't happen simultaneously. So I will want to watch out for at least another few quarters, maybe at least 3 to 4 more quarters of how this plays out before. It's not like the stocks are extremely attractive for us to, valuations are still above their averages of the last few years. So, and I will still want to watch out for some more time before becoming more positive on IT. I think there could be scope for further downgrades on both growth, top line growth, on margins and multiples.
And this would hold true for not just IT services, but engineering and ERD companies as well? Or could the playbook be different? They hold true for there as well. Okay, great. Ganeshram, it is always a pleasure chatting with you. I had a very long strategy note from you. I obviously couldn't cover everything, but maybe that leaves us with some room for conversation the next time as well. Thank you so much for talking to us today.
Thank you. Good speaking to you, Neeraj.
Yep, likewise. And viewers, thanks for tuning in to this very special conversation on Talking Point, whether it's the time to check in or check out.